Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Monday, May 3rd, 2021, and I'm pre-recording this Trading Places Live for Tuesday, May 4th. Futures currently down, extending those losses that we saw on the NASDAQ. Looks like NASDAQ overnight could get hit a little bit harder than the other indices. Right now, the Dow futures are down about 0.2%. The S&P 500 0.3%, and the Nasdaq futures about 0.4%. Nasdaq futures down about 57 points. So that comes on the heels of not so good action in the Nasdaq. We had a bifurcated day on Monday with the Dow and the S&P rallying while the Nasdaq lost ground. So that outperformance that the Nasdaq saw in 2020 is a distant memory at this point, as both the Dow and the S&P seem to have the upper hand. We're going to get into what happened on Monday in just a minute, but let's go through the agenda for today. We got the daily market recap. Then we're going to go into talking technically. I want to go back and take a look at the last couple of secular bull markets to show you the trend lines and how the trend lines tend to play out pretty solidly over long periods of time. I think you might find that interesting. Then we're going to get into break it down, taking a look at the healthcare sector and some of the various groups, industry groups within, and maybe even pull up and show you a couple of stocks within the group that have been performing pretty well. Then earnings spotlight, and we'll end the show with the three you must see. Before we get into any of that, let me take you over to earningsbeats.com. Love to have you join our community. We do have a free Earnings Beats Digest newsletter. Simply type in your name, email address, hit that subscribe button. We'll make sure you get added. It is a newsletter that's published 3 times a week, Mondays, Wednesdays, and Fridays in the morning before the market opens. We should, normally we have that out within 45 minutes or so of the opening bell. Talk a lot about earnings, relative strength, those types of things. Just give you a little bit of an idea of how we look at the market. Maybe can help you in your trading. Many of these articles are also trading opportunities. If you're a trader, you may find some of these to your liking. But we'd love to have you. So again, just go to earningsbeats.com. Make sure you sign up there. As far as the action on Monday, getting into the daily market recap, it was, like I said, bifurcated action. You got the Dow Jones Industrial Average posting a 238-point gain and back above 34,000, trying to make a breakout to an all-time high. I think we came up just a little shy. Then we had also the S&P 500, which was attempting to close above 4,200 for the second time in the last 3 days. It came up a little bit short at the close, but was nonetheless up about 11.5 points and finished at 41.93 on that S&P 500. The NASDAQ, however, a different story. And the selling that we saw at the beginning of Thursday last week, that was right after Apple and Facebook reported earnings, looked like we were getting a nice breakout on the NASDAQ. Since then, we've had selling right back down to the 20-day moving average. We'll see whether or not that holds on Tuesday, but at last check with the futures, it did look like perhaps the NASDAQ will open below that 20-day moving average. We'll see whether or not we hold it. Mid caps up about 0.5%. Small caps up better than that, about twice that, a little over 1%. So both of those smaller stocks doing much better than the overall S&P 500. You can see the S&P 500's gain was about 0.25%. So mid caps doubled that. Small caps about 4 times that, so about quadruple. As far as the sectors go, energy back on top, up 2.75%. Materials up about 1.5%. So really good move in both of those sectors. You can see both healthy. Materials been healthy for a while. Energy was in a bullish wedge, but I think it's broken out to the upside, and now we're trending higher. So I think energy looks pretty good here. The oil, this is just one of the industry groups, but the DJUSOI, you can see was up 5.5% on Monday, leading the charge, moving off of that 20-day test and clearing the 50-day on the close, just barely. But that was the first close above both the 50 and the 20-day moving averages since back in mid-March. So it's probably been about 6 weeks or so. Furnishings up 4.75%, making a new high. Wanted to point that out. And then delivery services, another huge day, up more than 4%. You can see there's been quite a rally in this group over the past week or so, probably up about 15% just in the last week. So this is a group that has caught fire recently. So you got companies like UPS and FedEx doing really well. All right, let's keep moving. Got the 10-year Treasury yield. As far as economic reports go on Tuesday, expecting March factory orders to come in at 1.3%, 1.3% rise. February was down 0.8%, but we are looking in our rearview mirror. March factory orders were already into May. I think the market knows that things are strengthening, so I don't really think that the March report is going to have a very big impact. Later this week, though, I do think we're going to have an impact from some key economic reports. On Wednesday, we've got the April ADP employment report coming out. Expectations there, 763,000. March was 517,000. So we're looking for a nice increase there. And then on Friday, April non-farm payrolls expected to jump up to 938,000 from the March level of 916,000. So that should be interesting. And also unemployment expected to drop below 6% down to 5.8% come Friday. So some economic reports, key economic reports to check out there. As far as the yield goes, I just think we're in a sideways range for now. Had a huge move up. I think we're consolidating that move up. I do believe the next big move is going to be back to the upside. I think we could go up and challenge 2%. I think that will help areas like the financials and the industrials. So we want to continue to focus a little bit on that, on those two groups from a short-term trading perspective. But we've got to see the breakout first. I think as long as we consolidate, we'll probably see a little profit taking in those groups. All right, moving on, let's talk about the S&P 500. So here in talking technically, what I thought we'd do today is take a look at this long-term secular bull market. And what I've done here is I've gone back and I've connected the highs since the bottom of the bear market in 2009. You can see we've rallied. And if you connect these highs, got a pretty nice trend line coming across here. And I know, we look at the market and we say, well, it's gone up so much. How could it continue to go up? Well, we haven't reached that top trend line yet. Doesn't mean we're going to. Maybe we're going to pull back before that. But if we do, just keep in mind, if we pull back, this trend line's continuing to go higher. So it's just giving us more room to make a move further down the road. If you look at the bottom and connect the lows, you'll see that we did violate. Now, the lows, the reason they don't connect exactly is what I've done is I've taken the same slope on the line here. And the way you do that at StockCharts, if you're annotating, is you grab a line like this, and I just hit the command and the left clicker, and I can just grab this and I drag the exact same line. And I go to that first low, and you can see that the second one over there, it just goes behind. Or goes below. If I connected that, then I wouldn't have anywhere to connect on the left side of the line over here. So the idea here for me anyway is we've got many more touches on the top side. So I think that's the key line. And then if we start here, I'm just thinking we probably hold this level if it wasn't for a pandemic, 100-year pandemic, which took us just a little bit below the level. But we bounced right back up and we're in this range. Now, this dotted line that's coming through here is kind of like the mid-range. And if you notice, we had a lot of bounces off of the mid-range. And the only two times really that we've gone down below, one was the trade war and the other was the pandemic. So it's taken a lot of fear in the market to actually pierce the blue dotted line. All right, so let's get out of this. And let's move. So this was the 2009. Actually, the secular bull market started really in 2013 when we broke out above the 2007 high. But it's still okay to go back and take key lows, key highs over the past 10, 12 years and connect those. So let's go back now. That was obviously the current market, but let's go back and look at the 1980s and the 1990s. When we were coming out of the 70s and into the early 80s, we started a new bull market. And if you connect the high in 1980 and the high again in 1987, notice that we almost hit that in 2000, that trend line. And if we go down and take that same slope and connect this low in 1982, it doesn't connect exactly, but this 1994 low is just about sitting on this trend line. And then again, I've got the blue dotted line, which kind of marks that midway point in this channel moving to the upside. And I know a lot of folks think, well, we've made such a huge run at the end of the 1990s, but it did come on the heels of not really doing that much. I mean, if you consider where we were in 1987, and then you look at where we were in 1995. I mean, at the top in 87, we were at, I don't know, maybe 370 or 340, something like that. And then in 1995, 8 years later, we're only at about 450. So it wasn't a huge move. And so I think the end of this bull market simply took off because we were in a bull market and we just weren't, we didn't really have huge gains for a number of years. So I think we played catch up. And of course, everyone thinks about, the last 4 years, and you think, okay, well, that was the reason why we had the big crash in 2000, the dot-com bubble. But I think it was just 20 years of secular bull market action that ended. It was going to end one way or another. And so it ended, and it became the dot-com bubble era, I guess. Let's go back and look at the 50s and 60s. So here we go into the 1950s, and we set our first big high in about 1956, made this huge run in the early 50s. But if you connect the 56 high, the 59 high, the 61 high, and then 65 and 66, got a pretty nice trend line. And if you go down to this first low, the first pullback, and connect these, you'll see that we had a really nice channel going again for about, in this case, about 15 years. And then I just drew that blue line there, just kind of the dotted line in between, just to give you a little bit of a, I don't know, sense of a midpoint within that channel. But very similar action in these secular bull markets. And then, of course, when we broke down here, you can see that was pretty much the end of the secular bull market run. So let's go back now with that history and just take a look at what we're doing here in this secular bull market. Now, if it started truly in 2013, keep in mind the one in 1981 started and went for 19 years. The one in 1951 went for about 19 years, 19 or 20 years. So when we finally make this breakout in 2013, I'm expecting this to go on for about 19 years, just following history, which would take us to about 2032. Now, that doesn't mean we go up every year. It doesn't mean that we keep riding this higher trend line, just keep going up, up, up for the next 11 years. The 1950s, if we go back in to look at the 50s, we had some pretty significant pullbacks and still stayed in this channel. If we look at the 1980s and 1990s, we had some pretty significant pullbacks. There's the 87 crash. This was the Gulf War in the late 1990 timeframe. So don't think that, when I say that we're in this uptrend for another 10 years, potentially 11, 12 years, doesn't mean that we're going to be going up all the time. We're going to have pullbacks that are going to test everyone from time to time. But I believe the overall trend continues to the upside, and I think it's going to last for another decade. Now, after that, if I'm right, we could be in for a rough decade, 10, 12 years. So I think now is the time to be, continuing to ride this bull market out. All right, let's move on to break it down. So in break it down, what I wanted to do first is just show you the healthcare chart. So this is just going back the last year. I think it's pretty clear, though, that after sideways consolidating over the summer and into early fall, we broke out, went up, put in new highs, came back down, held the prior lows, and then went up, put in new highs again. Now, I think the latest breakout occurred at about 118 on the XLV. So I wouldn't be surprised at some point if, we don't pull back and see maybe 118. That doesn't mean from here we're going to go straight to 118. I mean, we could break out, maybe put in a negative divergence, and then pull back to the 118 area. But I do think at some point that is a level that could be tested. So keep that in mind. But overall, I think this is, part of a secular bull market advance. I think that healthcare is moving higher. It's a rising tide lifts all boats kind of mentality. And I don't think healthcare is the best area of the market, but I think it is trending nicely to the upside. It held the 20-day moving average and it bounced off of it on Monday. So I think this is an area certainly that is, at this point anyway, doing very well. Let's bring up the industry group charts and let's take a look at these. All right, let's see here. There we go. So first up, medical supplies. And medical supplies, I think we set a nice high in February, pulled back, almost put in like a cup here off of an uptrend. Nice little cup, handle back to the 20-day. And I think medical supplies here is looking pretty strong. So I have no problems with medical supplies. What you're looking for there is a breakout to confirm the pattern. Next up, biotechs. Biotechs have been a pretty weak part of the market for the last year on a relative basis. You can see biotechs in middle of July last year were up at 2,600. And just a couple of days ago, we were barely above 2,650. And this is in this wild move back up to the upside that we've seen. So biotechs have not really been participating, which tells me that if we get the breakout above 2,750, I think it's worth paying attention to. So I think biotechs, because they've been languishing now for so long, I think as we get closer to summertime, this is a group that I think we want to continue to watch very closely. I think we could have a nice summer out of biotechs. Next up, healthcare providers, HP, DJUS HP. We made a breakout here back in March above the January high, went back, hit the 20-day and bounced off of it. We continue to trend higher. I think healthcare providers looks nice. Then we go into the medical equipment group. Medical equipment group just made the breakout above the February high, pulling back, but getting close to that 20-day moving average. I would be looking for a breakout there, or a rebound there, I should say. And then pharmaceuticals. Pharmaceuticals, I would say at this point, probably the weakest in this area. Didn't quite get a cup, but if you look at this off of the high, came back down, put in a left shoulder, neckline, head, right side of the neckline, and then you can see the right shoulder. The breakout above this neckline around 670, went all the way up almost to 690, pulled back, tested that 670 area, and now starting to move back to the upside again. A breakout above about 692, 693 is what you're looking for here on the pharmas. But when I look at all five of these industry groups, I think healthcare is fine. Do I think they're going to be the best performing group in 2021? No, I do not. But I do think they're going to participate, and I think you can find some nice trades. So the way I would go about this is the way I generally will go about it if I have an industry group. I'm either going to, well, I could go into my the charts that were the chart lists that we do, where we've got our strong earnings, strong future earnings, raised guidance, and so forth, and look for stocks that are maybe poised to move higher if, in fact, healthcare goes higher. So let me pull up the raised guidance chart list, and we'll view all. And if I go to summary form, and then I just type in healthcare, it'll tell me any stocks. And here they are. Here are the ones that have raised guidance. Now I'm going to change the percentage here so that we've got the top performers. But we might even go back and say, okay, what's been going on over the last month? Well, some of these have done very well. Which ones haven't? Now, keep in mind, these are all stocks that have raised guidance. So FLGT is one that I mentioned in our in my daily market report to members recently. And they're going to be reporting, actually, they may have reported today, or they may be reporting after hours, FLGT. I've got 5.3. Well, there's an easy way to check it. So if I go in here, FLGT, it's not saying earnings were, oh, it's saying next earnings date 5/6. So this one's going to report on Thursday. So FLGT will be reporting Thursday. That'll be an interesting report, given that this is a company that's raised guidance. It's also, we're seeing the healthcare providers, which have been strong, and this is one that raised guidance. I don't know, maybe they disappoint with their earnings, but you wouldn't think so after raising their guidance recently. Anyhow, this is a stock that's been down 24% in the last month. So you don't have to chase. A stock like FLGT, when I look at it, I would want to make sure I hold on to this support area. We're almost right on it. I mean, this is an area where I'd really like to see this stock hold. If it doesn't and it keeps moving lower, then I think you got all these tops down here where that's all the way down the low 50s. So it's sitting at 76.48. If earnings disappoint, I think in time we could move down to the low 50s. If earnings are better than expected and we get a rebound off this area, we may be bottoming. So this is one that I would certainly keep an eye on. Now, another way to approach this, if you know you're looking at healthcare and then you're, interested in maybe finding some outperformers, the other thing you can do is just go back to your dashboard at StockCharts and under Member Tools, scroll over here until you get to RRG chart, or not RRG, sorry, Scooter Reports. Scooter Reports, and type in healthcare. And it comes up with the best scooter scores, large cap healthcare stocks. So that's another way to maybe look at it. And if you want mid cap or small cap, just change your menu there. And now your highest scooter mid cap stocks come up. And then small caps, you can do the same thing. And that might help drive you to some stocks that have been performing well, or maybe you want to look at stocks within this space that have gone down a lot, maybe over the last week. Well, I don't know if I'd go with something that's dropped 84 points on its scooter score, but maybe if you get a scooter in the 60s or 70s that have come down of 20, 25 points recently, that might be a way to go in and take a look, see if you can find some charts that have gotten beaten up recently that could be poised to make a rebound if, in fact, we get the breakout on the healthcare stocks. So that's how I would approach it. I mean, there's obviously a lot of different ways you could use scans to run some scans to try to find what you're looking for, whether it's a 20-day test, maybe it's a 20-day high, whatever it is within this group. If we get a breakout, maybe you want only stocks that are breaking out. Maybe you don't want to, the laggards. Everybody's got different styles. But these are just a couple of examples of how you can go about trying to find stocks that fit your criteria if, in fact, healthcare begins to outperform and starts to break out. All right. Let's move on. I'm going to get into earnings spotlight. I tell you what, after hours, the earnings and some of the reactions have been pretty unbelievable, but somewhat consistent. And I'll talk about that in just a second. But here we've got Nutrien, NTR. This is in the materials area. They reported 29-cent earnings. Market was only expecting 9 cents. So more than a triple on earnings. Now, it looked to me like it was flat. We'll have to see how we open in the morning. But this is a stock that's been performing pretty well, rising, and then just been consolidating lately. So if you look back right in here when it topped, on a relative basis to its peers, it was near a 52-week high. And then as it consolidated, it lost a little bit of its relative strength. But like I said, just came out with strong earnings. I would expect to challenge those highs, if not break out, with the kind of earnings that came out. But strong earnings have not always resulted in a strong move to the upside. Let me give you another example here. XPO. After hours, the stock is down a little more than 1%. It's been up pretty nicely recently. They posted $1.46 in earnings versus 93 cents expected. Huge beat. After hours, stock was down 1%. Oh, by the way, they guided higher in the next quarter. So you've got a stock that beats estimates, raises guidance, and is down 1%. And if you think that one's bad, check out iRobot, IRBT. So they're expecting to earn 6 cents. They came in 41 cents. They beat their revenues. They raised their guidance going forward. And the stock, not only has it been down recently, but the stock was down 9% after hours. I think it was trading down around 94. which just seems like a little bit of an overreaction to me, especially given that the stock hadn't really made much of a move to the upside. To show that kind of growth, raise guidance, and not be rewarded is a little bit of a head scratcher. Let me give you another one here. Well, FANG is one I'm going to be watching closely tomorrow. Because FANG, if you look at it, it's in a nice little pattern, nice uptrend, looks like a cup to me, pulling back a little bit. Now, they did beat $2.30 versus $1.73. Stock was down fractionally after hours. But what I've noticed, and we did an earnings reaction spreadsheet recently, we've got hundreds of companies on it. And the one thing we've noticed so far throughout this earnings season is that energy stocks, that is the only sector that averages moving higher after the opening bell on the day after earnings. So with a stock like FANG, if it does gap down, there's some history here so far in this earnings season that suggests that maybe FANG would rebound after gapping lower. So again, energy stocks on average, I think there's been 30 companies through last Thursday, 30 energy companies had reported with market caps above 1 billion. And of those 30, I believe 18 of them had finished higher the next day after earnings. But the average intraday gain from the opening bell to the closing bell, the average on those 30 stocks was just over 1% gain. All of the other 10 sectors have averaged losing during the day after earnings. And technology's averaged earning has averaged going down 1.89%. So that's a huge disparity between what's been going on in energy the day after earnings come out and what's been going on in technology. So just wanted to point that out. All right, let's move on to the three you must see. Let's wrap this up. First up is Estee Lauder, EL. Check out that candle after coming out and beating earnings. That was the reward. Now a lot of good news was built in, so you can see sometimes sell on the news, but this was pretty rough. 8%, $25, back down below the moving averages. Certainly looks like we're heading back down to test this 265 to 270 area. Next up is ServiceNow. ServiceNow taking a hit the last couple of days after earnings, and it's got some decent support down here just above this 460 level, and it sure seems to me like we're heading in that direction. What I'd like to see is maybe a move below 460 intraday and then come back up and close above 460. That might mark a bottom and certainly would be a solid reward to risk entry point. Last one I wanted to show you is another one of these tech stocks, and this is what I've been talking about. AMD gapped up, came out with a huge earnings report, completely blew away estimates. Big gap up, looked like it was ready to start to right the ship, and here we are 4 days after reporting earnings. Lots of volume coming in, and this stock dropped from about $89 to 78 and change. That is a lot of selling, a lot of distribution taking place on AMD, and you can see that in the AD line moving down there. So anyway, earnings season's always kind of a hit or miss, kind of a 50-50 coin toss, and that's really what we've been seeing so far this year. Anyhow, everybody have a great day on Tuesday. Hopefully the markets rebound. We'll get a little rebound on the NASDAQ. Watch the key support levels, recent support on the NASDAQ. Make sure that holds. Then we'll go from there. Have a great day on Tuesday. Happy trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.